You usually only notice the plumbing in your house when a pipe bursts.
Right, exactly.
You don't really think about the water pressure or the routing until you're literally standing in a flooded living room.
Hmm.
But imagine if, while you were distracted by a storm outside, someone came in overnight and just completely replaced your entire foundational water system with a radically different architecture,
Yeah.
and the water never even stopped running.
Which is fascinating because that underlying infrastructure fundamentally alters the flow of capital, often before the broader public even realizes a change has occurred.
Welcome to the Daily Market Brief for Thursday, April 9th, 2026. While the world's attention has understandably been completely captivated by the intense geopolitical conflict in the Middle East over the past few months.
Okay, the headlines have been nonstop.
Exactly, but there has been this massive, quiet revolution happening in the very plumbing of our global financial markets. Today, we are deep diving into the perpetualization of traditional commodities.
Yet, we are basically observing the death of the traditional Monday to Friday trading week.
Wow.
The legacy market structure is just being rapidly replaced by this 24/7 crypto-native infrastructure. The industry is calling these TradFi perps, which are perpetual swap contracts directly tied to traditional real-world assets like gold, silver, and crude oil.
And to give you a really comprehensive picture of how this happened, we are synthesizing a massive stack of fresh sources for you today. We're pulling from a landmark data report released literally today by BitMEX Research, a brand new Bloomberg PR announcement from yesterday. Some really in-depth legal analyses of U.S. derivatives regulations from Katmuch and Rosenman, and real-time geopolitical reporting from outlets like The Guardian.
Because for anyone listening, whether you're an active investor managing a complex portfolio or just someone trying to understand the macroeconomic forces shaping the global economy,
Right.
understanding how things are priced in today's environment is just as critical as knowing what they're priced at. The actual mechanisms of price discovery have permanently shifted.
So this deep dive is really your ultimate shortcut to understanding how 247 markets have fundamentally altered that price discovery. Okay, let's unpack this. The catalyst here wasn't like a bunch of tech developers in Silicon Valley deciding to build a shiny new trading app.
No, not at all.
This architectural shift was violently forced upon the market by real-world conflict.
Yeah, the migration of traditional assets onto crypto rails over this last quarter, it was almost entirely driven by geopolitical escalation, just colliding with antiquated market structures.
So looking at the reporting from The Guardian, the catalyst really centers on the severe escalation in the Middle East dubbed Operation Epic Fury.
Right.
This involved coordinated U.S.-Israeli strikes on Iran's primary energy export hub at Karg Island.
Which is massive.
Huge. And that subsequently led to the closure of the Strait of Hormuz, which is arguably the most critical oil artery on the planet. And the market reaction was immediate and violent.
Yeah, Brent crude prices skyrocketed.
They went from the $69 to $74 range, peaking at nearly $120 a barrel.
And the structural vulnerability of Wall Street is totally exposed during events exactly like this. Because traditional commodity markets, they operate on a very rigid legacy schedule.
Right, the 9 to 5.
Exactly. They close their doors on Friday afternoon, and they do not reopen until Sunday evening.
Yeah.
But, geopolitical crises don't adhere to exchange hours. Missiles and drone strikes happen on Saturdays.
Okay, wait, I have to push back here. So if a major strike happens on a Saturday, a traditional Wall Street oil trader literally just has to sit on their hands and watch their portfolio burn until Sunday night.
Well,
Because TradFi institutions have massive risk management desks, right? They build complex volatility surface models, they use proxy hedges, OTC options. Are we pretending they're just completely paralyzed?
paralyzed? No.
No.
But effectively trapped? Yes.
Trapped.
Yeah, because those proxy hedges rely heavily on historical correlations. If an institution is using, say, airline stocks or correlated foreign exchange pairs to hedge weekend oil exposure, that strategy works fine for a normal 1 or 2% move. But when a kinetic military strike takes out the Karg Island infrastructure on a Saturday, those historical correlations instantly disintegrate.
Oh, wow.
The proxy hedge just bleeds out, or it simply fails to capture the sheer magnitude of the event, while the underlying spot price of oil jumps 40% in the real world.
So they can't get out.
Exactly.
Yeah.
The institution is trapped in a burning building because the primary exit door, the traditional exchange, is literally locked on a timer.
And capital is inherently self-preserving.
Absolutely.
It's going to flow to the environment where it can manage risk directly and instantaneously regardless of what day of the week it is. And that desperate need for weekend liquidity is what drove these institutional traders off Wall Street and onto 2,047 crypto-native platforms. They needed a way to trade crude oil on a Saturday afternoon.
Right, and they found it in TradFi perks.
Okay, so since they needed this Saturday liquidity, they turned to perpetual swaps. But what exactly are they, and how is this even legal?
So perpetual swaps completely solve the weekend lockout problem. But to understand the migration, we have to look at the mechanics of it.
Okay.
Unlike a traditional futures contract, which has, a hard expiration date at the end of a month or quarter where the contract must either be rolled over or settled for physical delivery.
Right, somebody actually gets a barrel of oil.
Exactly. But a perpetual swap has no expiration date whatsoever.
Okay, let me see if I'm tracking the mechanics here. If there is no expiration date where the contract has to settle against an actual physical asset, the price needs some sort of artificial gravity to stay tethered to reality, right?
Yes. They use a funding rate mechanism.
Right. So is the funding rate essentially like a financial thermostat?
How do you mean?
Like if the room gets too hot, meaning the longs are aggressively bidding the perp up, making the contract price run way higher than the actual spot price of crude oil, the air conditioning kicks in, meaning the algorithm forces those buyers to pay a continuous fee to the sellers.
Exactly.
And that cools the price back down to match reality, right?
That's a perfect analogy. The mechanism specifically weaponizes the cost of capital to force that convergence. And it isn't a fee paid to the exchange, by the way.
Oh, it's not?
No, it is a direct peer-to-peer transfer. If you are on the crowded side of the trade, your margin balance is drained continuously, sometimes every 8 hours, or in an extreme volatile environment, every single hour.
Wow.
The thermostat constantly punishes the side of the market that is straying too far from the real-world spot price. The real magic here for institutional traders is the combination of extreme capital efficiency through high leverage and the total elimination of rollover friction.
But wait, the legal analysis we looked at from Kattenmuch and Rosenman highlights that historically, crypto derivatives tied to real-world assets have been a massive regulatory gray area in the U.S., if not straight up banned.
Oh, for sure.
And institutional capital usually runs screaming from regulatory ambiguity. So how did this happen so fast?
The U.S. regulatory landscape transformed at light speed. The new administration's pro-crypto directives, specifically Executive Order 14178, it completely altered the environment.
Oh, right.
The CFTC pivoted sharply away from their previous era of regulation by enforcement. So instead of issuing subpoenas, they focused on clear rulemaking.
So because the CFTC essentially waved the green flag by allowing these perpetual-style contracts to begin trading on U.S.-regulated exchanges, like DCMs such as Binomial and Coinbase derivatives, we didn't just see a trickle of retail money.
No, the institutional floodgates opened.
Right. And now that we understand the why and the how, let's look at the sheer scale of the migration outlined in today's BitMEX report.
The data is honestly staggering.
It really is. In the first quarter of 2026, TradFi perpetuals exploded. Commodity perps alone grew by 65,463%.
Yeah, that number, it's hard to even process.
Putting actual dollars to it makes it even wilder. They started January with a modest $38 million in weekly volume.
Which is practically nothing in global finance.
Right, a drop in the bucket. But by the end of March, that weekly volume hit $25 billion.
Incredible.
Billion with a B. And if you add in equity perpetuals, the total TradFi perp market peaked at over $30 billion weekly.
And the report notes this now represents nearly 2% of all exchange-traded crypto derivatives globally, which in a single quarter is a massive capture of market share.
Totally. And looking at the venue breakdown, Binance captured a dominant 62.7% of that market share.
But the rise of decentralized venues is equally vital here. Hyperliquid captured nearly 30% of the volume.
Wow.
And they operate entirely on-chain without a centralized clearinghouse. And BitMEX itself saw over 1,300% growth in this specific vertical.
Okay, here's where it gets really interesting. With all that capital sloshing around looking at what they're actually trading, I mean, you would assume crude oil would dominate entirely given the Middle East headlines.
Naturally, yeah.
But by mid-March, silver ticker XAG actually took the crown. It accounted for nearly 35% of all commodity perp trades, beating out crude oil at 27.7% and gold at 27.5%. Why silver? I get oil because of the conflict, but why did silver take the lead?
So silver presents this highly unique dual nature that creates a perfect storm for high leverage traders.
Okay.
On one hand, it behaves like gold as a traditional macroeconomic safe haven asset during times of war and inflation fears.
Right, flight to safety.
Exactly. But on the other hand, it is a critical industrial component.
Mm.
It's heavily utilized in the booming artificial intelligence hardware sectors, as well as green energy infrastructure, like solar panel manufacturing.
Oh, I see. So it has the geopolitical fear premium strapped directly to the structural tech boom demand.
Exactly. That dual pressure makes the underlying asset wildly volatile. And if you're trading a perpetual swap with high leverage, volatility is your oxygen.
Volatility provides the opportunity for outsized returns.
Provided you can survive the liquidations, yes. But the weekend trading of these assets introduces a severe architectural vulnerability.
And this is the part that bends my mind. So, billions of dollars are flying around, trading silver and crude oil on a Saturday. But the traditional data feeds the oracles that tell the crypto exchange the real-world price. They're effectively asleep because the actual market is closed.
Right.
How does the exchange's thermostat know what temperature the room should be?
This is arguably the most fascinating and complex quirk of this new system. It comes down to how different platforms mathematically handle what we call oracle gaps during the weekend.
Oracle gaps, right.
Because the underlying traditional market is frozen, the crypto exchanges have to invent rules for how far the perpetual contract is allowed to drift from Friday's closing price.
And the BitMEX report details that these rules are not standardized at all.
Not even a little bit.
Like Binance, for example, freezes its reference index at Friday's close and then applies a mathematical collar. The price is constrained to only move plus or minus 3% over the weekend based on a smoothed moving average.
Right. And Hyperliquid uses a similar collar, but they cap crude oil at a maximum plus or minus 5% move.
But BitMEX takes a fundamentally different architectural approach, don't they?
They do. They don't apply a hard end ceiling at all. Instead, they allow their internal order book to move freely, constrained only by a rolling 2% limit per hour.
Okay, so when Operation Epic Fury happened and the strikes hit, this created an absolute collision of these differing algorithms.
A massive arbitrage event, yes.
Because crude oil didn't just move 3 or 5% over the weekend, it gapped massively higher in the real world as the news broke. So Hyperliquid hit that 5% artificial ceiling and just legally stopped.
Exactly. The contract could not trade any higher, even though every trader on the planet knew the true value of oil was soaring.
Meanwhile, on BitMEX, because they only had an hourly rolling limit, the price kept climbing hour by hour to match the geopolitical reality.
And the arbitrage event that followed was just chaotic. You had the exact same synthetic asset trading at vastly different prices, depending purely on the venue's specific algorithmic guardrails.
So it's like having 3 different sports books offering wildly different odds on the exact same game because they're using different rule books for overtime.
That's a great way to put it, yeah.
But isn't this incredibly dangerous for retail traders? If I'm trying to trade oil based on breaking news, I'm not actually trading oil anymore. I'm trading a blind bet on an exchange's specific algorithms.
You are, and this really highlights the immaturity of the market. While real-world asset perps are rapidly establishing themselves as the 2047 price discovery layer, these uneven liquidity pools and massive pricing dislocations mean things get dangerous fast.
Right.
Furthermore, the funding rate differentials were wild. For instance, an equity contract like an SPY or Coinbase stock might offer an annualized funding rate of negative 100% on one exchange.
Negative 100%.
Yeah, meaning the longs were bleeding out massive capital. But that exact same asset on another exchange might have a positive 1% rate.
That's insane.
It is. The market makers providing the liquidity are instantly incentivized to pull their bids to avoid toxic flow when these gaps happen. So a commodity trade can easily turn into a structural trap.
Man. Well, Wall Street isn't just sitting back and watching this happen, right? They are actively building bridges to this new 24/7 world.
They have to. They can't ignore the volume.
Right. Because yesterday, April 8th, Bloomberg announced a major expansion of their index coverage. They launched the BCM Global Commodity Singles Indices.
Which is a huge validation.
Exactly. It allows for professional-grade, granular tracking of individual commodities like energy, metals, agriculture, well beyond their traditional flagship 25-component index.
It validates the exact need for granular single-asset commodity tracking that mirrors the action happening on crypto-native venues. Professional traders operating in these perpetual markets require highly specific data.
And it doesn't stop at commodities. These TradFi perp platforms are already expanding into Forex, right? Like trading the euro against the dollar or the dollar against the yen, and even sovereign bonds.
Yes, the infrastructure is completely expanding.
So what does this all mean? Is the traditional ringing of the opening bell dead?
I think we are moving toward a permanent change in market structure. The idea that global finance operates on a 9-to-5 schedule with weekends off is becoming entirely symbolic.
Wow.
Crypto rails, the blockchain and smart contract tech, they are no longer just an isolated casino for trading Bitcoin.
Right.
They are actively becoming the new underlying plumbing for all of global finance.
Okay, let's bring this all back to the immediate present. Where do the markets stand exactly this morning?
Well, news broke overnight of a fragile ceasefire brokered in Islamabad, led by U.S. delegations.
Right, and as a direct result, that massive violent spike in Brent crude has stabilized somewhat. We're seeing it settle this morning between $99 and $101 a barrel.
The acute tension is paused, but the structural market shift remains intact.
Because the open interest, the total volume of active contracts sitting in these perpetual markets remains at absolute record highs.
Exactly. The institutional capital experienced the 2004-7 access, and it has not retreated. The genie is well and truly out of the bottle.
So if you're listening to this and you've built your investment strategies around markets that safely close on Friday afternoon, you have to adjust your framework.
You really do.
In a world that never sleeps, the markets have finally caught up. Thank you so much for joining us on this deep dive.
It's a permanent evolution, for sure.
Before you go, I want to leave you with one final thought to mull over. We started by talking about the plumbing of the financial system being entirely replaced while the water was still running. Well, if global markets now truly trade 24 hours a day, 7 days a week, without any breaks for weekends or holidays, how long until human traders are completely phased out of the loop?
That's a good point.
Because if the market never ever sleeps, it might soon only be habitable by algorithms and AI that don't need to sleep either. Think about that next time you check a commodity price on a Sunday afternoon.